2015 was again a disappointing year for the global economy. The World Bank's Global Economic Prospects report finds that global growth fell short of expectations, advancing at a 2.4% rate, the slowest pace since the financial crisis. Even though advanced economies like the United States and the euro area accelerated modestly in 2015, emerging market and developing countries slowed down. This was in large part because prices for commodities, such as oil and iron ore, have fallen considerably. It was also because flows of international trade and capital are lower. Most of the largest emerging market and developing economies slowed in 2015, for the third year in a row. That's a worrisome development. We haven't seen this many developing economies slowing down at the same time in the last 30 years, with the exception of during the recent financial crisis. This is a concern because many of these emerging market economies have been mainstays of the global economic engine for years. Seeing them falter raises questions about global growth in the years ahead. Moreover, some of the conditions behind slower growth, such as weak productivity growth, policy uncertainty, and lower commodity prices, appear likely to persist for some time. Looking ahead, we do see global growth picking up modestly to 2.9% in 2016. We also expect growth in developing countries to accelerate to 4.8% in 2016. These forecasts depend on a wide range of factors. They depend on a bottoming out of declining commodity prices. They depend on the advanced economies growing more solidly. And they also depend upon China's ability to continue its gradual transition to more consumption and services-based growth model. There are also a number of risks to our growth outlook. Many of the factors that have conspired to slow growth, low commodity prices, sluggish global trade, and disappointing productivity growth are expected to persist. Also, many developing countries could face higher borrowing costs as the United States raises interest rates. We took a close look at how the recent slowdown in the major emerging markets is affecting growth around the world. A 1 percentage point drop in major emerging markets growth would cut growth in other emerging markets by about 0.8 percentage points and global growth by about 0.4 percentage points. So, when major emerging markets sneeze, other countries risk catching cold. The decline of international trade was another factor, pressuring emerging markets and developing economies. In this context, we examined the potential economic implications of the Trans-Pacific Partnership signed by 12 Pacific Rim countries last October. If ratified, the agreement would boost trade and growth among its members. The Trans-Pacific Partnership would not necessarily steer very much trade away from non-member countries and might even benefit them by streamlining trade rules and standards. Despite some bright spots, such as accelerating growth in India and improving prospects in advanced economies, the outlook points to an era of weak growth and formidable risks for emerging markets and developing economies. So, what to do in this difficult growth environment? Credible macroeconomic and financial sector policies could help build resilience. Emerging and developing economies could stimulate growth through fiscal and monetary policy measures if they have sufficient room in their budgets and central bank policies to undertake such steps. Most importantly, they need to implement reforms that could convincingly address obstacles standing in the way of sustainable economic growth.